Welcome to Section 4 of the ASC 470 Debt Accounting Training Series. In this section, we are going to cover one of the highest stakes areas of debt accounting: how to classify debt between current and non-current on the balance sheet. We will look at the general classification rules, then go deep on two scenarios that trip up even experienced professionals: covenant violations and the refinancing of short-term debt as long-term. By the end of this section, you will be able to apply the 12-month rule to classify debt correctly at every period end. You will know exactly what triggers a reclassification of long-term debt to current when a covenant is violated. You will understand what makes a waiver valid and why timing is everything. And you will be able to apply the two-condition test for refinancing short-term debt as long-term, including the critical distinction between intent and binding agreement. Before we get into the rules, let us talk about why this matters so much. Debt classification between current and non-current is not a footnote issue. It directly changes the current ratio, which is one of the first metrics lenders and credit analysts look at when assessing financial health. Move a large long-term loan into current liabilities, and your current ratio can drop dramatically. That can trigger covenant breaches in other agreements, restrict borrowing capacity, or signal distress to the market. And the rules require you to reassess at every period end. This is not a one-time decision. The foundational rule is straightforward. Any principal due within 12 months of the balance sheet date is classified as current. Everything else is non-current. For a simple term loan with scheduled principal payments, you split the balance at every reporting date. The upcoming 12 months of principal goes into current liabilities. The rest stays in non-current. The non-current portion is presented net of unamortized discount and issuance costs. This sounds simple, but the complications come from two scenarios: covenant violations and refinancing. That is where the real judgment lives. Here is the decision table that covers most situations. Start with whether the principal is due within 12 months. That is always current. If it is not due within 12 months but there is a covenant violation and no waiver, the entire balance may need to move to current because the lender has the right to demand immediate repayment. Short-term debt stays current unless you have both the intent and a binding agreement to refinance it long-term. And debt refinanced under a valid long-term agreement before the financial statements are issued may be reclassified as non-current. Each of these has specific requirements we will cover in detail. This is where things get interesting and consequential. A covenant violation is not a minor technical issue that you disclose in a footnote and move on. Under a ASC 470, if the lender has the right to demand immediate repayment, which most covenant violations trigger, the entire outstanding debt balance must be reclassified as current. Imagine a company with $50 million in long-term debt that violates a leverage ratio covenant at year-end. $50 million moves from non-current to current liabilities overnight. The current ratio collapses. Credit analysts call. That is the real-world impact of getting covenant monitoring wrong. Most commercial loan agreements include a package of financial covenants. Minimum liquidity covenants require the borrower to hold a floor level of cash at all times, a tripwire that can be hit suddenly in a cash crunch. Leverage ratio covenants cap the debt-to-EBITDA multiple, and because EBITDA can move down as debt stays the same, these are particularly sensitive to earnings deterioration. Debt service coverage ratios test whether earnings can cover debt payments. Tangible net worth covenants protect the lender against equity erosion, and reporting covenants, often overlooked, can be violated simply by being late with your audit. Each of these can trigger reclassification. The rule is triggered by the existence of the violation at the balance sheet date and the lender's legal right to demand repayment, not by whether the lender actually demands it. Most people assume that because the lender has not called the loan, classification is fine. Watch out for this one. That assumption is wrong. If the right to accelerate exists at the balance sheet date and no valid waiver has been obtained before the financial statements are issued, the debt is current. The lender's inaction is not a waiver. Only a documented, formal waiver counts. Here is the key thing. A waiver is only valid if it meets all four requirements. It must be in writing. A phone call with the relationship manager does not count. It must be signed by someone with authority to bind the lender. It must be in your hands before the financial statements are issued or available to be issued. And it must either permanently waive the violation or give you a grace period that extends beyond 12 months from the balance sheet date. Miss any one of these, and the waiver does not protect you. A waiver received the day after you issue the statements is a subsequent event. It cannot change the prior period classification. Think of this as a race against the financial statement issuance date. The moment a covenant violation is identified at period end, the clock is running. You have the window between balance sheet date and issuance, which for many organizations is 6 to 10 weeks, to negotiate, obtain, and document a valid written waiver. If you cross the finish line with that waiver in hand, the debt can stay non-current. If the waiver arrives the day after you issue the statements, you have already disclosed the violation and classified the debt as current. There is no going back. Proactive covenant monitoring is the only way to protect against this scenario. When short-term debt matures within 12 months, but the company plans to replace it with long-term financing, the question is whether it can be classified as non-current now. The answer depends on two conditions being met simultaneously before the financial statements are issued. First, the entity must intend to refinance on a long-term basis. Second, and this is the condition that trips people up, the entity must have demonstrated the ability to do so, evidenced by either a completed refinancing or a binding signed agreement with a lender. Both conditions must be met. Neither alone is sufficient. Most people assume that if management intends to refinance and has had positive conversations with a lender, that is good enough to reclassify the debt as non-current. That is not what happens. The standard requires ability, not just intent, and ability means a binding legal commitment. A board resolution reflects intent. Management's expectation reflects intent. Even a preliminary term sheet or a lender's letter of interest reflects only intent. None of these constitute the binding agreement required by a ASC 470. If the signed agreement is not in place before the financial statements are issued, the debt stays current. No exceptions. Let us walk through 5 scenarios side by side. A standard long-term loan with no issues, straightforward split at the 12-month mark. A covenant violation where you secured a written waiver before issuance. The debt stays non-current. A covenant violation with no waiver. The entire balance moves to current. A short-term note where a binding refinancing agreement was signed before issuance. Classify as non-current. A short-term note where the board approved a refinancing but no agreement is signed. It stays current. The common thread in every scenario is the same: documentation in hand before the financial statements go out. Let us close with the 5 rules that cover almost every situation you will face. Principal due within 12 months is current, no exceptions. Reassess every period. A covenant violation forces the entire balance to current unless you have a written, signed, pre-issuance waiver. That waiver must arrive before the financial statements go out, not after. Short-term debt can only be reclassified as non-current when both intent and a binding refinancing agreement are in place before issuance. And intent alone is never enough. The board resolution does not protect you. Apply these rules consistently, document everything, and you will handle debt classification with confidence. Thank you for completing this section on Current vs. Non-current classification. Thank you for watching. Subscribe for more training from P&J Group.